Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at why IV matters on Tecrium Corn Fund, CORN, which in essence tracks the price of corn using corn futures, but you can do it in your regular securities brokerage account. We're going to take a look at a couple comparatives to the last time CORN was trading at a similar price till now, the only difference being a huge jump in option volume and implied volatility, and whether you're bullish, bearish, or neutral, how to go about capturing that. So let's jump in and take a look, shall we? First of all, took a look. Here's a scanner from Wednesday when it first kind of popped up on the radar. You can see over 27,000 option contracts traded versus a little more than 3,000 on average. More importantly, IV with the stock unchanged on the day jumped up at the highest level we have seen over the past 12 months. We'll take a look at that in a second. Friday, we saw it again on the unusual option activity list. As you can see, over 37,000 contracts trading on Friday versus now about 4,000 or so average volume because of that big recent volume spiking the volume. So the volume certainly has jumped implied volatility, but ever so softly weakening here down to the 98% level versus 100% here. So that's set up for a couple trade ideas we'll take a look at in a second. Here's that IV we were referring to right here. You can see the 120-day IV. You can see making by far the highest level we've seen over the prior 12 months, finally starting to revert a little bit here. We like to see that before we jump in, right? We're more than willing to take advantage of these IV spikes, but if we can catch it when it's starting to pull back a little, we don't mind jumping in front of the train. We want it to slow down though, right? As you can see here from Thursday to Friday's close, IV pulling back finally. Here's kind of a 20-day look at a generalized IV. 20 days ago was trading under 17 and certainly around the 20 area. Got briefly over 40 right when we saw that huge spike, and now finally pulling back, but still very rich over 32. The long end November seeing the majority of the volume right with over 13,000 contracts trading, but moving back of 2 vol points. Here's a long-term look at IV, 120 days, slightly out of the money call. You can see IV well behaved, right? Hugging basically that kind of 20 level with a few bumps and dumps, right? But then when we saw that recent option activity come in, absolutely spiked IV to the moon, finally starting to revert here. So set up with a couple trades. If you want to follow that flow, and most of this is absolutely call buying, lean a little bullishly, right? If you want to just capture the vol and do it in a more neutral fashion, or if you want to take a more bearish approach, given the technicals, we certainly can do that as well. So here are the trades we're looking at, right? So pulled off our comparative date going back to June 7th, and taking a look at the chart, you can see here's our comparative date on June 7th going back here, right? You can see corn finally starting to pull back 9-day RSI, which had reached over 80, now back in kind of a mid-range. MACD actually generating a short-term kind of sell signal after getting to about the highest level we've seen since the highs back here, right? Bollinger percent B also softening. Here's another look at IV. That too also reverting a little bit. So our comparative date was here when corn was trading at virtually the same price, and we can take a look and see what that jump in IV, right, has done to option prices. So pulled off the last time it was here, the stock was at 1862 on June 6th. It's 1 day lag on this. You can see those November 20 calls, which are about $1.40 out of the money, right? Trading at roughly 50 to 55 cents, right? The stock at 1862. So you can see that the buy right buying the stock, selling the calls would have cost you a little bit over 18 bucks, $18.10, right? I pulled off the straddle as well, selling the call, selling the put, both, right? It was trading about $2.32, right? Trading right around a 20 IV, right? Just under 20 on the puts, just over 20 on the calls. So if you want to do a more neutral trade, selling that straddle, right, would be a little more neutral. You'd be slightly long, right, selling a 67 delta and then selling a 33. So you'd be about 34 deltas net long. Certainly buying the stock, selling the shares, right, you'd be about 67 deltas net long right back then. And then obviously the call price at 52 cents. We'll take a look at a call spread in a second here, take a bearish approach. Fast forward to Friday's close, we can see now IV has jumped to over 30 on the puts, over 33 on the calls, right? We're seeing calls now outpacing puts as well, which is another sign maybe the rally is starting to slow down here. So the call price has actually gone up, even though the stock price now is at 1858 versus our benchmark date at 1862. So it's dropped 4 cents, right? But the call price has gone up, right? So I pulled off the comparative. So here on June 6th, our benchmark sort of date, stock at 1862, that $20 call was trading a little bit over 50 cents. Days to expiration, right? I used the day November's back then, 167 days to expiration. Using the Augies now, 146. So less days to expiration should make the option price cheaper, right? Less time makes options cheaper. But because of this huge jump in IV, right, of over 13 vol points, the options basically more than doubled in price, right? Even though the stock is further out of the money, right? The $20 call at 1862, right? You're $1.38 out of the money. Now $1.42, not a big difference, but a slight difference. Certainly 21 less days should make the option cheaper, but because of this massive jump in IV, what we saw here, right, this huge run up and then the spike on IV, we saw that the call price more than doubled. So set up ideally, right, for that covered call trade back then on our benchmark day, trading at $18.10. Friday's close, 1746. So if you want to follow the flow, right, very simple trade, buy the stock, sell these out of the money. It's very expensive now, calls, right? The $20 calls. Leave yourself plenty of upside, right? You got $1.50 upside, plus you're bringing in over $1.10 in net premium to kind of hedge the trade. You're getting in for 64 cents cheaper, right? With the stock only 4 cents cheaper. So you're able to buy the stock cheaper, sell the call at twice the price, lean bullishly with that big call buyer out there. And notice too, the deltas now on these back then, right? The deltas were 67 on the puts, 33 on the calls, right? Fast forward. We see the delta on the call now at 43, even though the stock's lower with less time to expiration. Why? Because that huge jump in implied volatility. So you get a theoretical bigger kind of downside protection, right, by selling a 43 delta instead of that previous one that was about 10 deltas less, right, all because of that huge jump in IV. And obviously you're getting a much richer price, able to sell the call at more than double the price, able to buy the stock a little bit cheaper and have less time, 21 days less to expiration. So certainly buying the stock, selling the call, a very simple way to take advantage. Follow the flow out there if you think that corn is going to continue to run up here. And it's all due to kind of the Iranian crisis. A more neutral is that straddle that we talked about, right? The 20 straddle, right? Back then, as we said, it closed at 232 with the IV. We're hovering right around 20. We can see on Friday's close, it had jumped basically pretty much a buck, right? With IV just exploding, with the stock not moving, and less time to expiration, right? 21 days less to expiration, yet you're able to sell this straddle at a lower price. And remember, you're only 17 deltas net long, right? Because of that huge jump in IV, you're able to capture the fact that the deltas are absolutely affected by the jump in IV here. So when IV reverts, right, yeah, you'll get a little bit longer delta-wise, but the price of the straddle will come down sharply indeed. So you have a very nice edge on that. Or if you're more bearish, right, based on the fact that we saw corn kind of looking like it's maybe slowing down here. We shall see, right? Welcome to trading, who knows, right? But an out of the money call spread, right? Back then, the 2022, right, was trading about 22 cents for about a 12% return on risk, right? Fast forward to Friday, right, because of that huge jump in IV, that 2022 call spread, right, defined risk, basically doubled in price. You're able to get twice as much, right, and pretty much twice as much return, all in a defined risk manner. And for those who want to get further out of the money for the same net return, right, pulled off, going back to our benchmark date, right, the 2022 call spread, as I said, trading around 22.5 cents or so. But if you want to get further out, now you can sell the 22.24 and get maybe a little bit more net credit, but have 2 points or 10% more upside protection, right? So increase your return a little, certainly give yourself more protection, do it in a defined risk manner. So that's another choice if you want to get further out of the money for the same net credit as we always talked about, these huge spikes in IV, and certainly this is about as huge as it gets, right? Give you the advantage, right, of basically either saying I want a bigger return for the same net risk, or I want the same return for a lot less net risk, and this one has a much bigger cushion, shorter time to expiration by 21 days, right? So anytime you can get further out of the money in a shorter time period and get just a little bit more, basically the same price, I think certainly makes sense as well. So that's what we look to focus on here day in and day out at big time options. But as we always like to say, right, trading is all about probability, not certainty. So find the edge, then put on the hedge, and make sure you position size accordingly. So until next time, as always, here's a good trading.